Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Alix Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at companies' exposure to U.S. tariffs.
Plus, we'll discuss why one of the biggest producers of heavy machinery expects lower sales this year.
But first, we begin with the tech space and the IT company Super Microcomputer.
This week, the company reported preliminary results for the fiscal third quarter that fell short of analyst expectations.
The company attributed the miss to customers delaying purchases, which were pushed into the current quarter. Supermicro also cited higher inventory reserves and expedited costs for new products.
For more, we are joined by Jin Ho, Bloomberg Intelligence Senior Technology Analyst.
We first asked Jin to break down exactly what happened in Supermicro's preliminary announcement.
It looks like, when you go big whale hunting and you miss those whales, you're going to miss results, right? They essentially miss sales by about $1 billion versus the midpoint of their guidance. And the fact of the matter is these AI deals are monster deals. That's why I'm saying it's big whale hunting. 100,000 GPU cluster that XAI or OpenAI, those are $3.5 billion deals. So if you miss on one or two of these, that accounts for easily $1 billion.
So, Wooj, is this a super microcomputer specific issue, or is this big tech spending kind of slowing down here?
Well, it's a product transition issue, right? So if we look at the NVIDIA GPUs, they transitioned over from the last generation, the Hopper series, to the next generation, the Blackwell series. And given the greater capacity and the better computational power, the customers were actually waiting for this for quite some time now, and now they're clamoring for it. So essentially what customers appear to be doing is canceling their Hopper orders and moving over to Blackwell. Now, I will tell you, they weren't the only one that had this issue. HPE, a couple of months ago, they missed their expectations primarily because of this product transition as well, and it's biting Supermicro now.
So based on that, the chip cycle is moving really fast for AI. So what's next after Blackwell? This is just going to keep happening and kind of rolling it downhill?
Yeah, I mean, it's still probably a couple of years before we start seeing the newer series of chips really ramping up. So we probably have a 2-year product cycle. Before we get to that, Alix, I mean, let's see how the cloud CapEx holds up in 26 and 27. But for now, right now we have a near-term product cycle issue for at least Supermicro and HPE.
Wooj, what are your companies, kind of the tech hardware companies, what are they saying about this whole tariff climate? Is it going to be an issue for them?
Yes, well, we published an update to our tariff note, and surprisingly, they've actually done a good job navigating the tariff issue so far. I've had 3 companies report that's hardware related. There's a couple of things we need to take into consideration. One, a lot of them are outside of China in terms of the manufacturing scope, so the tariff impact is fairly minimal. 2, there's a lot of manufacturing that comes out of Mexico. So, because of the U.S., Mexico, and Canadian trade agreement, USMCA, they're exempt from tariffs. So if you have anything that's built out of Mexico or Canada, whatever's assembled there, you're exempt from tariffs. The companies that have reported, they're using USMCA to their advantage to win deals. And 3, and this was somewhat interesting to me. I had thought there would have been some pull-in deals because of tariff concerns in the second quarter. The guidance thus far, Western Digital, as well as Seagate, which manufactures hard drives, they don't see any pull-in deals. So the second half of the year, which was a concern of mine, we see actually smooth demand going into the second half.
Our thanks to Jin Ho, Bloomberg Intelligence Senior Technology Analyst. We move next to news from the logistics company UPS.
This week, UPS said it expects to cut 20,000 jobs this year and close dozens of facilities due to a reduction in shipments for Amazon.com. This is in an effort to cut expenses and improve profitability.
UPS also didn't update its full-year outlook, citing macroeconomic uncertainty. And this comes despite the company reporting first-quarter earnings that beat analyst estimates.
For more on this and the state of the shipping industry, we're joined by Klaskow, Bloomberg Intelligence Senior Transport, Logistics, and Shipping Analyst.
We first asked Lee to give us his take on what we heard from UPS.
If I had to break it out, I would probably say 95% of the, I guess, somewhat disappointing 2Q outlook is really being driven by the macro and not UPS. I mean, UPS, in our view, is and has been doing the things to kind of restructure its network to deal with the realities of their business and how much it's changed over the last couple of years. And they're also focusing a lot more on revenue quality. So that would mean trying to win more share of small to mid-size shippers. Also, you noted they're kind of gliding down, if you will, their exposure to Amazon, to some of their businesses. That just doesn't make sense. I mean, they're still going to do returns for Amazon, which is a good business for UPS from a margin financial standpoint.
Hey, Lee, what kind of visibility does UPS have on their revenue stream? Like, how much is contracted versus how much is just me walking up to a store and, shipping a package across the country?
That's a great question, Paul. I think the reality is that they have somewhat a decent visibility into their business a couple weeks out. I think that's really about it. That's just really because it's their customers are really driven by economic activity, and it's really tough to kind of really gauge those volumes, especially in the current environment, given the uncertainty driven by tariffs, which is why earnings expectations for the second quarter will probably start moving lower as sell-side analysts adjust their models.
The Amazon stuff is a good thing for them long term, right? Even though there's near-term pain, like those are lower margin packages that they don't want to do anymore. They're going to focus on higher margin packages that could wind up being much more stable and profitable, right?
Yeah, to your point, they are really they're really focusing on revenue quality. They mentioned on the call that some of their business out of Amazon's fulfillment centers just really wasn't profitable for them. So it obviously doesn't make sense to take that business. And if they're able to create capacity by getting rid of some of this business and filling it with what they call SMB, small to mid-sized businesses, that's just going to be a good thing for its margins overall, and it'll allow them to generate the kind of returns that they can reinvest in their network. Because while they're doing a lot of investing in now in automation, and they're closing some facilities just to be a little more nimble than they were in the past, they're still going to continue to have to make those investments because technology continues to change, and those benefits will need to be driven by those investments.
Lee, a lot of companies are saying, they're not necessarily seeing the impacts of tariffs now, but they certainly expect to in the coming weeks and months. You cover everything in shipping: rails, trucks, the ocean shippers, the air freight guys. You cover it all. Are you seeing it now? Because I've actually seen some reporting that maybe fewer ships are sailing from China to the U.S. Are you seeing it anywhere in your space?
Yeah, we are. And to your point, bookings from China to the U.S. are down 30 to 40%, depending on which press reports you read. Some of that is obviously there was a pull forward effect in our view before the tariffs were going into place, so people were rushing to get stuff out. So we don't know really where that's going to lie. Shippers are going to they're going to take the stance where they're going to be like they're going to sit back and wait to see what happens. Some are continue to do business as usual, and they're just going to try to push off the costs associated with tariffs to customers, which obviously will be inflationary, or a mix of the two. So really, it'll be interesting to see how things progress.
Yeah, but still, I mean, you have to wonder though how fast then the shipping industry can re-rate. Like if there's like one ship hanging out at the LA port, all of a sudden tariffs go away, what does that wind up looking like?
Yeah, shipping companies can do a number of things to manage their capacity during ups and downs time. They can do blank sailings, which really just means they don't go to a port, they skip a port. They can operate slower, which actually is good because it could save them on fuel. And in a worst case scenario, they can just take the ships out of the water because that can be costly. And also, a lot of them, they lease their capacity from other companies. So, once those leases come up, they can just return the ship to the owner of that ship.
Haley, I know you cover rail and truck companies that do a lot of business across the Mexican border. What are you seeing there these days? Or what are they telling you?
Again, there's a lot of uncertainty. They saw a kind of a surge in demand ahead of the tariffs. There is a lot of exemptions in tariffs between the U.S. and Mexico and the U.S. and Canada. So, they are not as punitive as they are with China. That might be more of an inflationary aspect versus a stopping of flowing of freight. But the problem is that, if some of the supply chains get mucked up from the tariffs on China, that could impact manufacturing in Mexico and manufacturing in Canada, which will therefore, impact cross-border volumes overall. So there's kind of a wait and see approach here. I know that's not what people want to hear. They want certainty, but given the more protectionist policies out of Washington and how they can change on a dime, it's really hard to get that certainty. So hopefully in the coming weeks we'll get some better definitive outlook on where these tariffs are heading.
Our thanks to Klaskow, Bloomberg Intelligence Senior Transport, Logistics, and Shipping Analyst.
Coming up, we're going to break down how cruise demand has been impacted in 2025.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence via BI Go in the terminal. I'm Paul Sweeney.
And I'm Alix Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We move next to some new research from Bloomberg Intelligence about its BI Tariffs Matrix. It's a worst-case scenario tariff analysis tool that helps identify companies' exposure to U.S. tariffs, the potential impact on EBITDA, and how much prices have to rise to offset elevated costs.
For more, we were joined by Poonam Goyal, Senior U.S. E-commerce and Retail Analyst at Bloomberg Intelligence, and Elliot Stein, Bloomberg Intelligence Litigation Analyst.
We first asked Elliot how the BI Tariff Matrix works.
So the BI Tariffs Matrix available on the Bloomberg terminal at BI space Tariffs Go. And like you said, BI analysts for weeks have been putting numbers on what tariffs mean for their companies. And this is all distilled in the BI Tariffs Matrix. You go to the matrix, it lists 200 companies, and we're continuing to add more companies across 20 different industries. And it shows you what their blended tariff rate would be based on their exposure to different countries where they're getting goods for their sales in the US and what the tariff rates are on those countries. And then from there, our analysts have calculated how much the cost of goods will increase for all these companies' sales into the US, how much their profit will take a hit as a result, and how much they would have to increase prices both in the US and globally to offset the impact of the tariffs.
That's amazing. That's incredible. Honestly, this is why Bloomberg Intelligence is so awesome. And we'll get to retail with Poonam in just a second. But Elliot, when you were putting this together from all the different sectors, what stood out to you? What did you learn the most?
It's really interesting. So we also published a note on this, and in that note, there's a piece from Anurag Rana and the tech team. I like to filter by the blended tariff rate and see which companies are paying more tariffs as a result. And if you look at Apple, because they have such a high exposure to China, their blended tariff rate is still 20%. But a company like Dell has a much more diversified supply chain, and so their blended tariff rate is much lower, roughly I think maybe 4 or 8%. I forget the exact number. And so as a result, the amount that both these companies would have to increase their prices to offset tariffs varies quite dramatically, with Apple being close to 9% and Dell being close to 2%.
So Poonam, on the retail side of the business, how much more do you think consumers are going to have to pay at the store for stuff?
So if we assume that the entire cost is passed to the consumer. On average, across the 39 retailers we analyzed here in the U.S., it's a low double-digit increase. That said, we do expect some mitigation efforts to take place, so we do expect that to moderate to probably mid to high single digits, worst case scenario.
That sounds bad. Is that bad?
Price increases are bad, right? Because they influence demand, and that means that consumers could pull back in where and how they choose to spend. So ideally, we would like to see no price increases, low single digit at best, which we think is manageable. But if it's beyond that, there could be a pullback in demand, especially for discretionary items, right? Things that you can kind of hold off on, you can trade down for. So it is negative. If things worsen and if China tensions don't come down from here.
Are there certain product lines or certain categories, Poonam, that are more at risk? I just think, I remember seeing a story on sneakers, and it seems like all the sneakers come from China in that part of the world.
Well, they actually come mostly from Vietnam. So as long as the Vietnam tariff rates stay at 10%, which we'll know in early July if that's the case or not, I think that headwind is largely manageable. In fact, for the athleisure companies like Nike, Adidas, we've estimated that the tariff rate currently should only be around 10%. And that's because that's the current levy on the other countries outside of China. These companies have diversified a lot since the last round of tariffs, where they've actually moved out of China into the neighboring countries. And as long as the tariff is low there, we think it's manageable. If tariffs do increase in early July from the 10%, it's a bigger risk to these athleisure companies. Paul, you asked about where the impact is greater is across the 39 companies that we've analyzed. I think you have to look at the toy makers, you have to look at the dollar stores, and even some of the specialty apparel stores where they are more heavily exposed to China, in some cases largely exposed to China, and there the tariff rate is greater than 50%, and the exposure is much higher, so a much bigger impact.
Yeah, if you search by U.S. price hike and do, a top down, like Mattel, 31% estimated price increase, Five Below, 39%, Dollar Tree, 27%.
I don't think those people are going to like
I mean,
the people who shop at Dollar Tree. I don't think they're going to like that.
Really rough. I could do this forever. H&M, 20%. Target, where'd you go? Target looking at 20%. Elliot, are we going to see lawsuits, legal issues in relation to this?
Yeah, we already are. And just going back to the Matrix for a sec. So we didn't mention it, but you can click below the Matrix and to the left of the Matrix as well, because there are interactive calculators for all these companies where you can play around with some of the different assumptions, put in your own numbers, and get the output as a result. But in terms of lawsuits, we've seen multiple lawsuits being filed. My colleague Holly Fromm covers them, but I've been tracking them as well because they're interesting. We've seen lawsuits from importers as well as blue states like California and Oregon. They're filed in courts all around the country, but they're probably all on their way to being consolidated to a court here in New York called the Court of International Trade, which deals with lawsuits over tariffs. And there are two main claims in these cases. One is that the government is exceeding its statutory authority under IEEPA, which is the statute it's using, the Emergency Powers Act. And then the second one is that even if it does have the power under IEEPA to implement these tariffs, Congress delegated its authority to the president improperly. These are issues of first impression. We've never seen a president use IEEPA for tariffs before. And at the end of the day, we think it's a close call, but we think the administration will win these lawsuits and the tariffs will stick.
Our thanks to Elliot Stein, Bloomberg Intelligence Litigation Analyst, and Poonam Goyal, Senior U.S. E-commerce and Retail Analyst at Bloomberg Intelligence. This week, we got a tale of two different earnings pictures from the Royal Caribbean and Norwegian Cruise Lines.
Royal Caribbean raised its profit outlook for the year, saying that bookings for 2025 remain on track. Norwegian Cruise Line warned that cruise demand is weakening, citing softening in its 12-month forward bookings.
For more on this and the state of travel, we were joined by Jody Lurie, Bloomberg Intelligence Credit Analyst.
We first asked Jody for her broad take on Royal Caribbean versus Norwegian Cruise Line earnings.
I think that the interesting thing that we're noticing this quarter is the change in tone. And it's not necessarily that the companies are so pessimistic, it's that they're hedging their bets a little bit. They're reminding investors that they have a longer tail when it comes to bookings. They're reminding investors that even if the consumer starts pulling back on travel, which, Hilton commented on some of that, that they are at least well positioned for 25. And so Norwegian was trying to back out of comments around Europe being a little bit weaker by saying, hey, rest of the world is doing well. Royal Caribbean was sounding upbeat, optimistic, but I do suspect that there's an element of concern for all these companies.
So what's the best way for you as an analyst, Jody, to get a sense of how demand is going in the future? I know some of these bookings, as you mentioned, are far in advance, but how do you guys think about that?
So there's two things we do, Paul. So the first is we actually do a note every quarter or so around bookings related to Bloomberg second measure data. And by that I mean is that Bloomberg second measure data isn't necessarily a one-for-one on bookings, but you'll see that particularly going into wave season, that you can get a sense of what bookings are doing based on what sales is and volume is for these companies. We have intel into a little bit more into the brand depth being at Bloomberg, but beyond that, I mean, clients can look at a lot of that data as well, and it's really helpful. I mean, we wrote a note back in the fall that talked to 2025 still being strong for these companies, but aired a little bit of caution to the 2026 season, and that being a function of what we were seeing on second measure.
Do you get the sense that if we see sort of stalling out in consumer demand or just a little holdback, that it's deferred demand or disappearing demand?
So for the cruise lines, I mean, you have to think about it in buckets. So you have those dedicated cruisers that are going to cruise heck or high water. Those are the people who are going to jump in right after COVID. But I mean, I think for the new to cruisers, it's more of a question of if they're going to consider booking this far in advance, if they don't know what their wallet is going to look like. There is a function of people being able to back out coming into a cruise, but I'd argue that a lot of the time when people are making that decision, especially far in advance, they're not necessarily going to use that as the lever to pull when they need to free up additional cash, right? They're going to find other ways to access cash or capital. I'm talking individuals, I'm talking consumers, right? And so when we book our vacations, we're saying, okay, we're going. Now, it's the bigger question, and this is what we're seeing with the hotel, is for the people who haven't necessarily booked, they might be rethinking when they're going to book, what their vacation is going to look like, when are they going to book their airline, right? And I think that's key, is the fact that you have this long tail booking versus a shorter tail booking.
So, Jody, if I'm a cruise ship operator and I sense that my bookings are going to weaken going forward, what do I do? I mean, because my boat's like a floating piece of, I don't know, fixed costs there. What can I do?
You can just get the ship filled as much as possible, right? So something we learned from COVID for a lot of these companies is that really in order to be break even EBITDA, they need somewhere between 30 to 50% capacity for the cruising, right? And that's what a lot of the companies said when they were getting back up to speed. They said, you know, we need 30 to 50% of capacity, and then we're break even EBITDA. And I think that the key also is that these companies have really pushed the onboard spending, right? The ticket covers, a certain amount of the cost of sailing, but if they're going to be sailing either way, they want to fill the ship, because if you fill the ship, then you have more potential for additional spending on board. Even just from the basics of, I forgot a toothbrush, I got to go use the corner store on the ship because it's a captive market. But even beyond that, people, once they're there, they say, well, I'm already here. I might as well partake in the drink package, or I might as well do an excursion, right? I don't know the next time I'm going to be out. So I think the key will be, getting them on the ship, something that Norwegian talked about, which is different than the other cruise lines and speaks to some of the strategies that they did post-COVID, is not necessarily negotiating on price.
Our thanks to Jody Lurie, Bloomberg Intelligence Credit Analyst.
Coming up on the program, we're going to break down why McDonald's sales fell sharply last quarter.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alix Steele. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We begin with big tech and earnings from the world's largest software maker, Microsoft.
This week, the company reported stronger than expected quarterly sales and profit, and this suggests that customer demand for cloud services has held steady despite a wave of new tariffs and economic turbulence.
For more, we were joined by Anurag Rana, Bloomberg Intelligence technology analyst.
We first asked Anurag for his take on those third quarter results.
I think it's a cloud plus AI. I think that's the big gain over here. And as you said, I mean, this is a company that is probably 1/3 of the entire software industry, and it beat by a massive margin. I mean, it was, really, in terms of when you're walking into the quarter, you're looking at, constant currency growth rate of 12%. They beat it by 300 basis points, about 15% growing. Azure growth rate, which was 31% consensus, they beat by 35%. They're going to do another 34, 35 next quarter. So really, everything is going well for them. And that's partially because of their relationship with OpenAI and all the workloads that they are getting from that. I think that's really what's driving a lot of it. They came in, talked about the CapEx still fine. They're not shutting any data centers down. And I think this is probably the cleanest story in tech right now.
Is there a narrative yet coming from the software industry about a world of higher tariffs, Anurag, or are the software companies, like most everybody else out there, kind of wait and see?
No, you are looking at the non-AI IT spending being cut down or pulled back, but that's the second derivative impact. When it comes to direct impact from China, most of them don't have any other than buying boxes from China for expanding their data center work. But that's the kind of cost that perhaps sometimes even absorb, given the scale of the larger companies. The smaller ones will have some problems. But the tariff impact we are seeing in new bookings numbers, new guidance for the full year, people are cautious about it. But that's what I would call as a second degree impact.
What did you make of Microsoft lowering their CapEx just in terms of their expenditures, and then Meta increasing them? What am I learning from their CapEx numbers?
So Microsoft did not pay. I mean, Microsoft basically said they're going to be spending on short-term kind of projects, which is going more leases rather than building it on their own, which to us is fine because let's say there is some issue with demand over the next 2 years, they can counter that in a much more rapid progression than the others. Now, Meta is talking about more CapEx, but I have no idea how they're going to capitalize on it. And then, that's an area of question mark for them. For Microsoft, it comes through Azure Cloud Computing. For AWS, it's the same thing, but how are they going to capitalize it? Is a big question for Meta.
Our thanks to Anurag Rana, Bloomberg Intelligence Senior Technology Analyst. We move now to earnings from the fast food giant McDonald's.
This week, McDonald's reported that its U.S. sales fell sharply in the first quarter.
And this reflects a deterioration in consumer sentiment that's making it harder for restaurants to lure in diners.
For more, we were joined by Michael Halen, Bloomberg Intelligence Senior Restaurant and Food Service Analyst.
We first asked Michael for his take on McDonald's earnings results.
In the U.S., it was a messy quarter. It was definitely an underwhelming report, but there was a lot of noise. I mean, the weather was difficult for the restaurant chains in the first quarter. It was very cold in January, snowy in February. It was a bad flu season. They lost that leap year day, so that was hit comps by about 1%, right? So it was kind of messy, and I would say the value menu relaunch maybe didn't go as well as some might have expected. There's some things to get excited about. This month it was the Minecraft movie promotion. Next month is going to be the launch of McCrispy strips, and then in the second half we're going to see the return of the McSnack wrap.
Yeah.
And I think investors are looking forward to all those things, and easier comps and same-store sales should improve a good amount here through the year end.
All right. So, Alix, we had a remote broadcast a couple of weeks ago with the NJIT, New Jersey.
Oh, yeah, we did.
I went to the McDonald's at the Newark train station.
And?
Got the number 2 with a Coke, which has been my go-to order since I was like 12.
Mm-hmm.
Awesome
stuff.
Awesome. I mean, they deliver every time. I don't know. I'm not letting anybody speak a bad word about McDonald's. Hey, Mike, what are your restaurant companies? What are they saying about a world of tariffs? How does it impact their business? How much do they expect to take out of their margin versus maybe passing along to customers? What are you hearing these days?
Yeah, so what we're hearing on these earnings calls is just uncertainty, and I think most of our companies are taking this as an opportunity to kind of lower their guidance, their same-store sales, top-line guidance for 2025 here. Whether or not their business has been impacted by a consumer slowdown due to tariff concerns and anything like that. In terms of margins, we're fine. I mean, there's very limited exposure to imports in the restaurant industry. Companies, restaurant chains we cover, they're all sourcing a large majority of their goods domestically, right? And so margins aren't really an issue. I mean, Shake Shack actually increased their guidance for 2025 restaurant margins.
That's interesting. So would this be a relatively then defensive sector, dare I say, in a tariff environment?
Well, I mean, right now the market's trading as if, a recession is on the table. And in that case, consumer spending is going to pull back. I would say restaurants are probably better seated than maybe retailers, right? Because they have less tariff exposure, and the restaurant industry suffered a recession last year. And so we have easier comps to lap, right? And so for those reasons, it may be more attractive. But, if we do see a recession, you don't want to be owning consumer discretionary names historically.
So, Mike, I think I'm a pretty good restaurant feedback person because I'll go to the McDonald's in Newark train station, but I'll go to the top-end steakhouse as well. I'll go anywhere in between. Where do the different segments of the restaurant business, how do you think they're going to fare in an economy that is perhaps slowing down and perhaps even thinking about a recession?
It's really interesting this go round. And, we've been saying, and we continue to think that casual dining is going to outperform this year.
What's an example of casual dining?
Sure. Yeah. So casual dining, think Cheesecake Factory reported a solid report. A name we really like is Cracker Barrel.
Oh, boy.
You're speaking his language right now.
Great company. I know I am. So those chains, they're coming off of really, really weak results last year. And you have some turnarounds in the industry that are kind of boosting results, right? We've seen absolutely phenomenal results out of Chili's. We think the turnaround at Cracker Barrel is going to gain steam. And they have exposure to low-income consumers, but much less so than quick service. So quick service is lapping better comps from last year, tougher comps from last year, and they also have the highest exposure to low and middle-income consumers. And for that reason, we're a little bit more bearish on those names.
Mm-hmm. Well, yeah, exactly. And then you have the QSR, right? The quick service restaurants, which would be a McDonald's. Chipotle is a QSR, right?
Well, it's a quick service. They we have a whole new segment. Well, not that new, but kind of new segment called fast casual. Where
yes, that's right.
Price point's a little higher than quick service, a little bit lower than casual dining. The food's better than quick service, and in some cases actually better than casual dining as well. So yes, Chipotle, Shake Shack, Dutch Bros, Cava, they kind of all all are in that boat, and we're seeing different results, across that space. I think it was pretty, fast casual did pretty good last year, but we're seeing some headwinds. Chipotle didn't have a great quarter. There's been a massive slowdown in same-store sales at Wingstop, and so yeah. But so you're seeing, kind of a case-by-case basis in terms of the fast casual industry.
Our thanks to Michael Halen, Bloomberg Intelligence Senior Restaurant and Food Service Analyst.
We look next at earnings from one of the world's biggest producers of heavy machinery, Caterpillar.
This week, the company reported first quarter earnings that fell short of analysts' expectations.
Caterpillar also said it expects slightly lower sales this year if the Trump administration tariffs remain in place and the economy dips into a recession in the second half of the year.
For more on this, we were joined by Chris Ciolino, Bloomberg Intelligence Senior U.S. Machinery Analyst. We first asked Chris how he currently is looking at the company after reporting earnings.
I think the release really isn't as bad as initially feared, and there's actually a number of positive takeaways here. The quarter was weak, and we knew that going in. Volumes were going to be down, pricing was going to be under pressure, but the outlook is actually better than I think many had anticipated. Their 2Q sales guide was actually above the street. We saw backlog improve to a record $35 billion. Orders were up double digits, both year over year and sequentially. And really, if you look at their outlook ex tariffs, it was really better than what they had expected prior. So, and the tariff impact as of now at least appears manageable. So I think the release, should at least help allay some of those concerns over a more pronounced slowdown this year.
Chris, does Caterpillar build their equipment in the U.S.? Is that where the manufacturing is, or how do they do that?
Short answer, they build everywhere.
Okay.
They are a net exporter out of the U.S., but you have to remember, this is a large global manufacturer.
Yep,
They
yep.
have manufacturing footprint and supply base that really spans the globe. But if we're thinking about net exports, yes, they export more out of the U.S. than they do import. From a revenue perspective, the U.S. is, almost half their revenue today.
What about for its peers? What does this mean for some of its peers and the trading environment that they were previously in?
Yeah, so at least for some of the domestic U.S.-based manufacturers, I think this is maybe a little bit of a sigh of relief. By no means are we out of the woods yet, but it certainly seems that the tariffs, as of least how they stand right now, are somewhat manageable. Cat's expecting a net cost headwind of about $250 to $350 million next quarter. If you kind of extrapolate that out over the balance of the year, you're talking, maybe somewhere in the 150 basis point headwind to margins. But that may even prove, overly pessimistic because, Cat's still evaluating and implementing some of these mitigation actions. So we could even see that come down from here.
I was kind of surprised, I guess positively, Chris, that their backlog looks pretty darn good. It's not like their customers are canceling orders or anything.
No, and it's a record backlog, right?
Yep.
So, we have coverage, if you look at consensus revenue, whether we call it flat or down slightly this year, they've got coverage for, nearly 70% of the year already. So I think that does help provide some kind of buffer. There was a concern out there that do we see this pre-buy, ahead of some of the tariff implementation? And Cat really kind of downplayed that. And in conversations they're having with their dealers and with their customers, they're really not seeing any evidence of that. So yeah, these do seem like, true orders and really a really healthy backlog, which, I think helps support, that flattish type revenue outlook that they're putting out there.
All right, thanks to Chris Ciolino, Bloomberg Intelligence Senior U.S. Machinery Analyst.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.